Okay, this video continues our discussion of topic 958, not-for-profit entities, as well as subtopic 30, split interest agreements. And a few videos before this one, we've gone through the different types of split interest agreements in the overview and background section. So now I want to understand how do we recognize them. So the recognition piece would tell us when and where to recognize these split interest agreements. And then the initial measurement tells us what amount should we recognize. And then subsequent measurement would be in each different period end, what amounts do we need to change the balance to. And then derecognition, presentation, and disclosures, parts which we'll get to later on. But for now, let's understand when and where to recognize split interest agreements. And we remember from the prior video, there's basically two types. There's revocable agreements and irrevocable agreements. And so this video right here will be discussing revocable agreements. And that's in the subsection 25.2. And it says that revocable split interest agreements shall be accounted for as intentions to give. And that assets received by a not-for-profit entity acting as a trustee under a revocable split interest agreement shall be recognized when received as assets and as a refundable advance. So let's say a donor has put some assets into a trust, and they designated the not-for-profit entity as the trustee in a split interest agreement where some of those assets will be given to us and other portions of the assets will be potentially given to other beneficiaries, and that's what makes it a split interest agreement. But anyway, we have control of the assets, so therefore we record them on our books as our assets. But since it's a revocable agreement, which means they can basically cancel it, then we have to record a liability as a refundable advance in the case that we would have to give those assets back. So basically we record them when received, and we record them as assets on our books and as a liability for refundable advance. And so the only time we can record them as a contribution income would be when the agreement becomes irrevocable or when the assets are distributed to the not-for-profit for its unconditional use, whichever one comes first. So at that point, we would remove the liability piece and credit a contribution revenue because those assets now are fully ours for our unconditional use, and the agreement can't be revoked.